Hello, welcome back. One of the modules that I truly enjoy in our exclusive tool is the market news module because it tells me what is happening in the markets right now. And currently in Washington DC is 7:21 a.m. and you'll notice that the last news piece that we got is 7:06 a.m. This is Washington DC time. And this is very helpful because I can stay up to date very easily. And as you'll see here, as I was taking a look at the news, I checked this one. Elon Musk acquires 9.2% stake in Twitter. And so this is very big news. And right now, as you'll see in this, for example, Twitter is up 25%. And that definitely prompts me to take a look at Twitter itself. And this is what we're going to be doing at this video. We're going to examine Twitter and see whether it's actually worthwhile for us to potentially enter the stock. Because, while Twitter could be actually trading higher right now, and it's going to be 25% higher when the market opens up. By the way, I don't have pre-market rates here yet, but I am actually actively working on this, so in a couple of days it will be ready. But know that right now Twitter is at about $50 when the market opens up. The 1 year high has been 73 though. So you will see here that, let's just take a look at the 5-year period. You will see that, Twitter has been going down a little bit from what it used to be. So the P ratio here of the company is minus 142, so this means that the company is actually losing losing net income. It used to be positive at some point and pretty good value too, 20 and 17 here. And then things went astray during the pandemic really. Twitter looks like it lost a lot of marketing revenue. And the price to free cash flow ratio is actually following the same trend, going down. Now the outstanding shares is up 10%, and that's the 5-year period from 730 million to 800 pretty much. So a little bit of a dilution going on, about 10% in 5 years. That's like 2.5% a year. Not terrible, but I could do without it. So the free cash flow to total liabilities ratio here tells me how many years of free cash flow I need to pay back the total liabilities the company has. And that's the current free cash flow, the 1 year, the last year free cash flow. And because it was negative, we're getting a negative value here, meaning that we don't have enough free cash flow this year to pay back total liabilities. Now that's a figure that kind of shows me how much of the free cash flow I need to allocate in order to pay back the total debt of the company. This is the last year free cash flow, which is the odd one out actually for Twitter right now. So you would expect this kind of negative value, but it may not be exactly indicative, although it can tell you some very important things about the company. Now, the 5-year revenue growth has been positive, as you'll see, and keeps increasing, yet the net income went down again during the pandemic, and the same thing with the free cash flow. It used to be positive. Now, that 5-year total equity growth, you see it's 45%, but if you take a little bit of a closer look, you'll see that it went down during the pandemic year, so they lost some equity there. The other actually return on investment, for example, in these metrics have gone down again during the pandemic. The company hasn't been doing well, and that's a big thing for the company right now. Now, if you invest in this one, you can recognize that this whole pandemic thing will not keep on going forever. So you could be seeing the company trading higher. Now, you're gonna be getting, if you actually invest now, you're gonna be getting an about 25%. Discount basically, because it's going to be at about 50 when it opens up today in the markets. But regardless of that, we want to examine and take a little bit of a closer look and see what is going on in terms of the revenue of the company, for example. Now here you'll see 2020 fiscal year, actually they lost 1.1 billion and then they lost 220 million. So it looks like it's getting better, at least the loss. And again, I wouldn't just blacklist the company because they were doing well before the pandemic. And so this situation could be giving you a discount actually if they actually reverse it, which looks likely it's possible. Now, the total assets of the company, the total equity actually has been going down, as we noticed, not that much. They lost about 16%, it looks like, total. And the cash flow statement over here, which is very important. Now we will see over here, and it's worth noting that the company has a lot of stock-based compensation and a lot of depreciation and amortization added back to the free cash flow because these are not cash expenses. And so this skews the net cash provided by operating activities even for the previous years. Yet in the previous years, this would still be positive, not that much, because they had about like 800 million of these two, but this would still be positive, the net cash by operating activities, if you exclude those. And again, I want to examine those in a little bit of separation, isolation, just because they are expenses, they are just not cash expenses. So it's good to note this, especially these two, because they are added back to the operating activities cash flow, and they are not real operating activities cash flow. So that's important to know. I have even thought about explicitly pointing this out of the tool, but I don't want to confuse people really. It's good to know about this though. So the cash from investing activities has been going actually up, which is not a good thing really. It means that they are selling some investments. So they are selling maturities of investment or investments here, of investments here. As you'll see, they have been selling quite some. And in terms of financing, they are in the negative. So for the most part, it looks like they are repurchasing stock, and that's a good thing. And they are not adding back much debt. They are mostly repaying debt. Good thing to see. Now the free cash flow, yes, turned positive as you'll see here, turned negative as you'll see here. It used to be positive though, and that's obviously a good thing. But the last couple of years have been kind of bad for the company, again, probably because of the pandemic. Now, what is important, we do know that we're actually dealing with a company that has been doing relatively well, and then all of a sudden it started doing badly. Now, what do we do with this? Because we do know that we have some risk, but this risk may be mitigated by the fact that the pandemic is approaching its probable end. And so I'm expecting Twitter to kind of, reverse course and do better. Now, the thing is, I don't want to overpay for this. That's important because I am having a risk here. So what is the revenue growth that I will be using? I will use a 10, 12, and 14, 12 here, and 14. I think that's fair. And the net income margins, as you'll see here, have been all over the place, and the last years have been negative. Yet I'm gonna go with these years for my averages, and lower than this, of course. So I'm gonna go 25, 30, and 40. So I'm anticipating the company to reach its previous levels, its healthy levels back in 2018 and 2019, really. That's what I'm saying here, because otherwise these are negative and you cannot really go with those. Now, the free cash flow margin, again, 70 and 52 here. I'm gonna go somewhere in between 50, 60, and 70. And the annual return that I typically want to get is 13%. So let's hit calculate and see how we're doing with this. Now you'll see that our current price is 39 here, but it's actually 50. Remember that, it's gonna open up at about 25% higher. So we're at $50 and our high is at 42. So this is practically a red here when the market opens up. This means that if I'm buying the company right now, I'm overpaying even with these estimates here, even with these projections. And so that's not a buy for me right now. Now, I do expect that the company will be doing better and the price may increase, but if I pay $50 for the stock right now, I'm really overpaying based on what the company is doing. And these are actually maybe even overconfident estimates here, especially for the high one. So I'm not willing to pay for the company right now. I'm not willing to add it to my portfolio because I think it's expensive based on what they are doing, and they have been doing in the past. And so I do have the extra pandemic risk, and then I also have the extra risk that I don't know whether the company is going to reverse course and actually go back to the previous estimates that they were doing, the historical data that they were achieving. So I don't know that, and it may take a while also. And why would I pay for that today is the question. I wouldn't. This is what I'm saying here. So be cautious a bit about Twitter. Don't get too much into the fact that Elon Musk bought it. It pays to be cautious in the market and to wait for the proper time. Now, if you bought at 39, you would have a case. You would have a little bit of a case, even though even at this price it would be a little bit expensive. But you would have a better case. Right now at 50, I think it's a little bit too expensive to enter. I hope you enjoyed the video. Thank you for watching this far. Please remember to subscribe because at some point you will know how to get access to this tool and it's going to help you a lot with your analysis. Trust me, I use it every day. And like the video as well because that really helps with the algorithm. Thank you for watching again and I'll see you in the next video. Bye bye.